Warren Buffett made billions, not by chasing every trending stock or blindly following market hype, but by carefully avoiding companies that could erode his wealth. Understanding the reasons behind saying no is one of the most important lessons any investor can learn. In this first part, we're going to explore the foundation of Buffett's philosophy. His philosophy rests on a few simple, yet extremely powerful principles. First, he focuses on value investing over speculation, meaning he only invests in companies whose underlying business and financials make sense. He invests in companies where he can reasonably predict future cash flows. Second, he invests in durable businesses with strong economic moats, whether that's a brand, a cost advantage, or a network effect. These types of companies can withstand competition and economic downturns. Third, he looks for competent management that acts in the long-term interests of shareholders. Finally, he abides by the principle of never losing money, which in practice means avoiding high-risk, highly leveraged, or opaque businesses. This philosophy leads him to screen potential investments very carefully using tangible metrics. He looks at free cash flow, return on equity, profit margins, and debt levels. He often repeats in letters and interviews that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. To understand this better, consider the early 1990s, when the dot-com boom led many investors to pour money into fast-growing tech companies. Many investors did so without understanding the business models. Buffett, however, avoided this craze. He explained that growth alone does not make a company a good investment if it lacks predictability and durability. This avoidance protected Berkshire Hathaway from major losses when the dot-com bubble burst. Avoiding the wrong stocks is critical because making a poor investment can destroy years of compounded gains. Even a temporary loss early in your investing journey can set back wealth creation significantly. Typically, Buffett avoids several categories of stocks. First are complex businesses that are difficult to understand or whose operations are unpredictable. If the business is opaque, no amount of research can guarantee the safety of your capital. Second are companies with high leverage or unsustainable debt. These are vulnerable to economic downturns and could face bankruptcy if the market shifts unexpectedly. Third are overvalued stocks, where the market price is far above intrinsic value. Even a great company can be a terrible investment if you overpay. Fourth are companies with poor management or governance. These are companies where insiders are not aligned with shareholder interests. Decision-making in such companies is either reckless or short-term oriented. For example, Buffett historically avoided IBM prior to its later tech investments. It was not a weak company, but at the time, its valuation was high relative to growth. Its strategic direction was not yet aligned with durable competitive advantages. Another example is airline stocks, which Buffett famously avoided for decades. The industry's cyclical nature, capital intensity, and operational complexity made long-term profitability unpredictable. In evaluating companies, Buffett looks at numbers like free cash flow, operating margins, debt-to-equity ratios, and historical return on invested capital. A company with negative free cash flow and rising debt signals danger even if revenues are growing. That is precisely what Buffett avoids. Beyond numbers, he evaluates qualitative factors. He asks whether he can understand the business enough to explain it in one or two sentences to his investment partners. If he cannot, it goes on the do not touch list. The key lesson here is that saying no is as much a skill as saying yes. Avoiding mistakes compounds wealth in the same way picking winners does. By the end of this part, the takeaway is clear. Invest only in businesses you understand. Look for durable competitive advantages, competent management, predictable cash flows, and reasonable debt levels. Always ask yourself if the risk of losing money outweighs the potential gain. As we progress to the next part, we will dive deeper into the specific types of stocks Buffett avoids. We will discuss examples and red flags you can use immediately in your own investing decisions. This way, you can apply the same disciplined framework that has guided one of the greatest investors in history. Warren Buffett's strategy of avoiding certain stocks is not random. It is rooted in decades of experience, careful observation, and deep understanding of business fundamentals. In this part, we'll examine the specific types of companies he typically avoids and why these categories often spell trouble for investors. The first category includes complex businesses that are difficult to understand. These are companies where the revenue models, operational processes, or products are so intricate that predicting future performance becomes nearly impossible. Buffett believes that if he cannot explain the business clearly in a few sentences, it is not worth investing in. Complexity increases the risk of mistakes and surprises. The second category includes companies with high leverage or excessive debt. While some leverage can amplify profits, Too much debt increases the likelihood of financial distress, especially during economic downturns. Companies with excessive debt are vulnerable. Buffett has consistently warned that high-debt companies are much riskier than low-debt counterparts. Third, Buffett tends to avoid overvalued stocks, where the market price is significantly higher than the intrinsic value. Even if a company is profitable or growing quickly, overpaying for it can destroy long-term returns. He emphasizes that paying too much for a good business is worse than paying the right price for an average business. Another category includes businesses with poor or untrustworthy management. These are companies where decisions are not aligned with shareholder interests. Buffett looks for leaders who are capable, honest, and committed to long-term success. He avoids companies where governance or decision-making is questionable. Beyond these categories, Buffett also avoids companies in industries that are extremely cyclical or unpredictable. He also avoids industries subject to rapid technological disruption. For example, he avoided airlines for decades because profits were inconsistent. Airlines also require enormous capital and are vulnerable to competition or economic shocks. Similarly, early-stage tech companies were avoided before he understood their durable competitive advantage. In addition to qualitative factors, Buffett examines quantitative metrics. He looks at free cash flow, operating margins, debt ratios, and return on invested capital. Companies with declining cash flow, rising debt, low profitability, or unpredictable returns are generally avoided. He combines these numbers with qualitative judgment. He asks questions like, can I explain how this business makes money? Can it survive economic downturns? Are the managers trustworthy? Does it have a durable competitive advantage? If the answer to any of these is no, it walks away. To illustrate, consider Berkshire Hathaway's historical avoidance of airlines and early tech stocks. Buffett watched competitors struggle, profits collapse, and valuations fluctuate wildly. He decided that the risks outweighed the potential reward. His caution preserved capital and allowed him to invest in companies like Coca-Cola and American Express. In these companies, the business model was simple, cash flow, predictable, and management trustworthy. The key lesson for any investor is that avoiding mistakes is as important as selecting winners. By identifying red flags, understanding your own knowledge limits, and applying consistent screening criteria, you can prevent significant losses. This approach improves long-term wealth creation. In summary, Buffett's stock avoidance strategy revolves around complexity, debt, valuation, management quality, and industry stability. By studying these categories carefully, you can build your own framework for avoiding risky investments. In the next part, we will dive deeper into one of these categories. We will focus on financial red flags and warning signs that can immediately signal danger in any stock. These tools will help you screen out bad investments before they harm your portfolio. In this part, we will focus on the financial red flags that Warren Buffett looks for before investing in any company. Even a strong business can be a bad investment if the financials show hidden risks. Buffett examines both quantitative and qualitative aspects of a company's financial health. The first red flag is negative or inconsistent free cash flow. Free cash flow represents the money a company generates after paying for capital expenditures. If free cash flow is consistently negative, it indicates the company cannot sustain operations without borrowing or selling assets. Buffett avoids companies where growth is fueled mainly by debt rather than actual cash generation. The second red flag is high or rising debt levels. Buffett closely studies the debt-to-equity ratio and other leveraged metrics. Excessive debt can amplify risks, especially during economic downturns, and can lead to bankruptcy, even in otherwise profitable companies. Companies with unpredictable or growing debt relative to earnings are typically avoided. The third red flag is low or declining profit margins. Profit margins show how efficiently a company converts revenue into profit. Falling margins can indicate increasing competition, rising costs, or operational inefficiency. Buffett prefers companies with stable or improving margins over time. The fourth red flag is poor return on invested capital (ROIC). ROIC measures how effectively a company uses its capital to generate profits. Low or declining ROIC signals that management is not efficiently deploying resources. Buffett looks for businesses that can generate high returns on capital consistently. Another red flag is unpredictable revenue or profit trends. Companies with highly volatile earnings are harder to value and more likely to pose risk. Buffett prefers predictability in revenue and earnings, which allows for better long-term forecasting. Negative or unusual accounting practices are also warning signs. Buffett carefully reviews financial statements to detect one-time adjustments, aggressive revenue recognition, or unusual expenses. Overly complicated accounting can hide financial weaknesses, which increases investment risk. Buffett also pays attention to dividend sustainability. If a company cannot generate enough cash to pay a consistent or growing dividend, it may signal weak fundamentals. Another financial red flag is excessive reliance on external financing for growth. Companies that constantly need to issue debt or equity to fund operations are more vulnerable to market changes. Buffett prefers self-sustaining businesses that can fund growth internally. To illustrate, consider historical examples where Buffett avoided companies with rising debt and unpredictable cash flow. These businesses often struggle during downturns, while his investments in strong, cash-generating companies thrived. An important point is that Buffett combines financial metrics with qualitative judgment. Numbers alone are not enough. Management integrity and business durability are equally important. The key takeaway is that investors should always examine cash flow, debt, profit margins, ROIC, revenue stability, and accounting transparency before buying any stock. By spotting these red flags early, you can avoid risky investments and preserve capital. Remember, Buffett believes that protecting capital is just as important as seeking returns. A single bad investment can erase years of gains, so avoiding these red flags is critical. In the next part, we will explore another crucial category: high valuation traps that lure investors into overpaying for even good companies. We'll break down how to identify overpriced stocks and avoid the mistakes that many investors make. In this part, we will focus on high valuation traps that Warren Buffett avoids. Even great companies can be dangerous investments if the price is too high. Buffett emphasizes that paying the right price is as important as choosing the right business. The first trap is buying stocks with prices far above intrinsic value. Intrinsic value is the true worth of a company based on cash flow, assets, and growth potential. When market prices exceed intrinsic value significantly, returns diminish and risk increases. Buffett warns that overpaying can turn even a good company into a poor investment. The second trap is chasing growth stocks without regard to valuation. Many investors buy fast-growing companies assuming profits will continue indefinitely. Buffett avoids these if the price does not reflect realistic future earnings. The third trap is ignoring cyclical earnings. Some industries appear profitable during boom periods but collapse in downturns. Buffett avoids companies whose earnings spike temporarily and do not reflect long-term sustainability. The fourth trap is paying for hype or market sentiment rather than fundamentals. Stock prices can be influenced by trends, news, or speculation. Buffett waits for price and value to align, rather than following the crowd. He believes that patience is one of the greatest advantages in investing. Another trap is overestimating the company's competitive advantage. Even if a business seems strong, if its moat is weak or temporary, paying a premium is risky. Buffett evaluates whether a competitive advantage is durable enough to justify the price. Historical examples show that investors overpaying for hyped companies often suffer losses when reality sets in. Conversely, Buffett waits for opportunities where value is clear and risk is manageable. Metrics such as price-to-earnings ratio, price-to-free cash flow, and price-to-book value are used to spot overvalue. Buffett avoids stocks where these ratios indicate excessive optimism. He also compares a stock price to expected long-term cash flow to assess whether it is reasonable. A common mistake investors make is assuming that a company growing quickly now will always grow at the same rate. Buffett looks at historical growth, industry conditions, and competitive landscape to determine realistic expectations. He avoids stocks where the market assumes perfect growth without risk. Another red flag is speculative investments that rely on uncertain future events. Buffett prefers companies whose success is not dependent on unpredictable outcomes. He avoids investing in turnarounds or unproven business models at inflated prices. The key lesson is that price matters as much as quality. Even a wonderful company can become a poor investment if bought at too high a price. By recognizing valuation traps, investors can avoid overpaying and protect long-term returns. In addition, Buffett's approach emphasizes patience and discipline. He waits for opportunities where the market undervalues a high-quality business. He avoids making impulsive decisions based on market trends or hype. Investors can learn from this by setting strict valuation criteria before buying any stock. Screening for price relative to intrinsic value, sustainable cash flow, and durable competitive advantage helps avoid mistakes. In the next part, we will examine another critical area: cyclical versus durable businesses, and how Buffett chooses between them. Understanding these differences will help you avoid companies that may fail during downturns and focus on those that endure. In this part, we will explore the difference between cyclical and durable businesses and how Warren Buffett chooses between them. A cyclical business is one whose profits rise and fall with the economy or industry cycles. Examples include airlines, steel, automotive, and construction companies. During boom periods, These companies may appear highly profitable. However, during downturns, they can suffer huge losses. Buffett generally avoids cyclical businesses, unless the price is extremely attractive and the risks are understood. Durable businesses, on the other hand, generate consistent cash flow regardless of economic conditions. Examples include consumer staples like Coca-Cola, Procter & Gamble, and companies with strong brands or monopolistic advantages. Buffett prefers durable businesses because they are predictable, easier to value, and less risky over the long term. The second factor he considers is competitive advantage. Cyclical businesses often have weak moats, meaning competitors can easily erode profits during downturns. Durable businesses usually have strong moats, which protect profits over decades. The third factor is capital requirements. Cyclical industries often need heavy capital investment and have high fixed costs. In a downturn, this can lead to financial strain or even bankruptcy. Durable businesses require less capital relative to their earnings, making them safer investments. Buffett also evaluates management's ability to handle cycles. Companies with disciplined leadership that avoids overextension or excessive debt are preferable. Cyclical businesses run by aggressive or short-term focused managers are avoided. Historical examples show Buffett avoiding airlines, steel, and other cyclical industries for decades. He did not invest until the economics improved, risks were manageable, and management was exceptional. Durable businesses, however, have been the backbone of his portfolio for decades. Examples include Coca-Cola, American Express, and See's Candies, all of which generate predictable cash flow year after year. Another point is valuation during cycles. Even a durable business can become a poor investment if purchased at an excessive price. Buffett waits for opportunities where price and value align, whether the business is cyclical or durable. He emphasizes that understanding the nature of the business is crucial to assessing risk. Investors should categorize companies as cyclical or durable before considering any purchase. Cyclical businesses require careful timing, knowledge of cycles, and a margin of safety. Durable businesses allow long-term compounding with lower risk of permanent capital loss. Buffett also considers the resilience of products or services. Durable businesses often provide goods or services that people need, regardless of economic conditions like food, beverages, or essential financial services. Cyclical businesses provide products or services that can be deferred or avoided when the economy slows. This difference significantly affects long-term investment performance. The key takeaway is that investors should favor durable businesses with strong moats, predictable cash flow, and resilient demand. Cyclical businesses can be profitable, but require caution, timing, and deep industry knowledge. By understanding this distinction, you can avoid companies that may fail during downturns. You can also focus on those that endure and provide reliable long-term returns. In the next part, we will explore another critical factor Buffett watches closely: high debt and leverage. This will help you understand why companies with too much debt are often avoided, even if they appear profitable. In this part, we will discuss why Warren Buffett avoids companies with high levels of debt and excessive leverage. Debt can help a business grow, but too much debt can destroy it completely. Buffett believes that leverage magnifies both gains and losses, making companies more fragile. The first reason he avoids high-debt companies is the risk of financial instability. When a company is highly leveraged, even small revenue declines can cause huge financial pressure. This pressure can lead to missed payments, credit downgrades, or even bankruptcy. Buffett prefers companies that can survive downturns without depending on loans. The second reason is that debt reduces a company's flexibility. When a company must constantly repay loans, it has less money to reinvest in growth. This limits innovation, expansion, and long-term strategic planning. Companies with low debt have more freedom to operate and adapt to changing conditions. The third reason is interest rate risk. Rising interest rates increase the cost of borrowing. Companies with variable rate debt suffer the most because their payments rise instantly. Buffett avoids businesses vulnerable to such external factors. The fourth reason is unpredictable earnings. Companies with unstable or seasonal profits struggle to manage debt consistently. If earnings drop unexpectedly, the company may not be able to cover interest payments. Buffett avoids companies that cannot maintain stability during weak periods. The fifth reason is poor management behavior under pressure. When companies face debt issues, management may take risky decisions to survive. These decisions can include selling assets, cutting essential investments, or diluting shareholders. Buffett prefers management teams that make rational decisions without being forced by debt. Another red flag is companies that depend on borrowing for basic operations. If a business cannot generate enough cash flow to fund itself, it is not financially healthy. Buffett looks for companies that generate strong and consistent free cash flow. Excessive borrowing to cover operating costs signals deep structural problems. The next issue is cyclical volatility. High-debt companies in cyclical industries face double risk during downturns. Their profits fall while debt payments remain the same. This is why Buffett avoids leveraged companies in unstable industries. Buffett also checks the debt-to-equity ratio carefully. A high ratio indicates that the company relies too much on debt compared to actual ownership capital. He prefers companies with low or manageable leverage levels. Another concern is refinancing risk. Companies with heavy debt may need to refinance at higher interest rates later. If credit conditions tighten, refinancing may become impossible. Buffett avoids companies exposed to this uncertainty. Historical examples show that many large companies have collapsed due to excessive debt, not because of weak products. Buffett learns from these failures and chooses safer, financially solid businesses. The key takeaway is that debt is not always bad, but excessive debt can be deadly. Successful investing requires focusing on safety and long-term stability. Buffett prefers companies that can grow without depending on risky borrowing. Investors should study debt levels, cash flow, and interest coverage ratios before buying any stock. By doing so, you can avoid companies that may collapse under financial pressure. In the next part, we will explore businesses with poor management quality and why Buffett stays far away from them. Understanding management behavior is one of the most important lessons from Buffett's strategy. In this part, we will talk about why Warren Buffett avoids companies that have weak or unreliable management teams. Buffett believes that great management can lift an average business, but bad management can destroy even a great business. The first reason is lack of honesty and transparency. Buffett looks for leaders who communicate truthfully, even during difficult times. If management hides problems or manipulates numbers, Buffett immediately loses trust. Honest communication builds long-term confidence in the company. The second reason is poor capital allocation. Good management invests money wisely to grow the business. Bad management wastes money on unnecessary projects, overpriced acquisitions, or unproductive assets. Buffett avoids companies where leadership does not know how to use capital efficiently. The third reason is short-term thinking. Some managers focus only on boosting quarterly earnings instead of long-term strength. Buffett prefers leaders who make decisions that benefit the company for decades, not just months. Short-term thinking usually leads to weak strategy and unstable performance. The fourth reason is a lack of accountability. Great managers admit mistakes and correct them quickly. Poor managers blame others, avoid responsibility, and delay important decisions. Buffett avoids companies where leadership refuses to take ownership of failures. The fifth reason is overly aggressive behavior. Some CEOs take unnecessary risks to impress investors or chase rapid growth. These risky decisions can harm the company if conditions change. Buffett prefers calm, rational, and disciplined leadership. The sixth reason is poor treatment of shareholders. Some companies ignore shareholder interests or dilute shares without good reason. Buffett avoids businesses that do not respect the people who own the company. Good management always prioritizes shareholder value. The seventh reason is a weak company culture. When employees lack motivation or direction, performance suffers. Buffett believes that strong culture leads to strong results. Poor culture often comes from poor leadership. The eighth reason is inconsistent long-term planning. When management constantly changes strategies, the business loses direction. Buffett avoids companies without a clear and stable long-term roadmap. The ninth reason is reputation risk. If management is involved in controversies or unethical practices, the entire company becomes risky. Buffett avoids these companies to protect long-term stability. The 10th reason is lack of understanding of their own business. Some leaders do not fully understand what makes their company successful. Buffett looks for managers who deeply understand their business and industry. Historical examples show that companies with weak leadership often fail, even when their products are strong. Buffett therefore prioritizes management quality as much as business quality. The key lesson is that management behavior affects a company's future more than most investors realize. Strong leadership builds value. Weak leadership destroys it. Investors should understand how management makes decisions and treats shareholders. In the next part, we will look at another major reason Buffett avoids certain stocks: businesses with unclear or overly complex models. Understanding simplicity versus complexity is a core part of Buffett's strategy. In this part, we will explore why Warren Buffett avoids businesses that are too complex or difficult to understand. Buffett's most famous rule is simple: never invest in a business you cannot understand. The first reason is that complexity makes it difficult to predict future performance. If the business model is unclear, estimating profits, risks, or cash flow becomes nearly impossible. Buffett only invests where future results can be reasonably understood. The second reason is hidden risks. Complex companies often hide financial problems behind complicated structures. Buffett avoids situations where risks are not visible or easy to measure. Simple businesses reveal their strengths and weaknesses clearly. The third reason is unpredictable revenue streams. Some companies depend on multiple unrelated sectors. This makes it difficult to understand what is driving profits and what could cause losses. Buffett prefers companies with one clear, strong source of earnings. The fourth reason is complicated accounting. Complex businesses often use advanced financial reporting that can confuse investors. Buffett avoids companies with accounting that requires excessive assumptions or adjustments. Transparent accounting shows the real financial health of a company. The fifth reason is management dependency. Complex companies often rely heavily on specialized managers to keep operations running smoothly. If key managers leave, the entire company may struggle. Buffett prefers businesses that can operate successfully, regardless of individual employees. The sixth reason is lack of competitive clarity. In complicated industries, it's hard to identify the real competitive advantage. A business without a clear moat becomes risky over time. Buffett invests in companies where the moat is simple, durable, and obvious. The seventh reason is difficulty in valuing the company. When businesses have many moving parts, estimating intrinsic value becomes extremely difficult. Buffett avoids companies that cannot be valued with confidence. A fair price is only possible when the business model is easy to understand. The eighth reason is rapid technological change. Complex tech companies often change too quickly for reliable long-term predictions. Buffett prefers stability, not unpredictable transformation. He invests in companies that look similar today and 10 years from now. The ninth reason is limited circle of competence. Buffett openly admits he does not understand every industry. He avoids businesses that fall outside his knowledge base. Staying within your circle of competence reduces mistakes. The 10th reason is volatility and speculation. Complex businesses attract investors who are betting on hype instead of fundamentals. Buffett avoids companies that depend on market excitement. He focuses on businesses supported by real earnings and long-term demand. Historical examples show that Buffett avoided many complicated companies that later collapsed. His discipline protected him from unnecessary risks. The key lesson is simple. If you cannot clearly explain how a company makes money, you should probably avoid it. Understanding the business is the first step toward making a smart investment decision. In the next part, we will explore another crucial reason Buffett avoids certain stocks. Companies with weak or inconsistent cash flow. Cash flow is the lifeblood of any business, and understanding it is essential for long-term success. In this part, we will explain why Warren Buffett avoids companies that have weak, unstable, or inconsistent cash flow. Cash flow is the lifeblood of every business. A company can show profits on paper, but without real cash coming in, it cannot survive. The first reason Buffett avoids weak cash flow companies is operational instability. If a company does not generate enough cash to run daily operations, it becomes financially vulnerable. This forces the business to borrow money or sell assets just to stay alive. Buffett stays away from companies that depend on external support to function. The second reason is unpredictable future performance. When cash flow fluctuates heavily, it becomes difficult to predict future earnings. Buffett prefers businesses with steady, predictable cash flow that can be projected for years. Predictability makes valuation easier and reduces long-term risk. The third reason is poor ability to handle downturns. Companies with weak cash flow collapse quickly when the economy slows. Strong cash flow companies survive tough times without panic. Buffett invests in businesses that can remain stable even in recessions. The fourth reason is limited reinvestment power. Companies need cash to expand, innovate, and maintain operations. Weak cash flow restricts growth opportunities. Buffett prefers companies that can fund their own growth internally. The fifth reason is dividend risk. If a company cannot generate enough cash, it cannot pay consistent dividends. Buffett avoids businesses with dividends supported by borrowing instead of real earnings. Dividends should come from strength, not financial struggle. The sixth reason is high vulnerability to debt. Companies with weak cash flow often depend on loans for survival. This increases risk, especially when interest rates rise. Buffett avoids companies that cannot comfortably cover their interest payments. The seventh reason is inflated earnings. Some companies show strong profits, but generate weak real cash. This gap usually indicates accounting tricks or unsustainable operations. Buffett trusts cash flow more than reported earnings. The eighth reason is lack of financial flexibility. When cash is low, companies cannot invest in new opportunities. They also struggle during emergencies or market changes. Buffett prefers businesses that always have financial room to breathe. The ninth reason is poor competitive strength. Weak cash flow often means the company does not have strong demand or pricing power. Healthy businesses generate cash consistently because customers truly need their products. Buffett invests where demand is stable and dependable. The 10th reason is weak long-term compounding. Companies with inconsistent cash flow cannot reinvest consistently. This limits compounding returns over decades. Buffett knows compounding works best in stable cash flow companies. Historical examples show many companies collapsing because cash dried up, even while profits looked good on paper. Buffett avoids such misleading situations by focusing on cash, not hype. The key lesson is simple. Real cash flow reveals the true strength of a business. Investors should analyze operating cash flow, free cash flow, and consistency before buying any stock. In the next part, we will break down another major reason Buffett avoids companies. Businesses with no real competitive advantage or economic. Market manipulation happens when certain players artificially influence a stock or crypto price. Warren Buffett avoids companies involved in any form of manipulation because it creates false valuations. The most common type of manipulation is the pump and dump scheme. In this scheme, a group spreads hype to pump the price up quickly. After the price rises, they sell everything, causing a sudden crash. Regular investors usually buy during the hype and lose money when the price falls. This creates an unstable market, which Buffett never wants to be part of. Another manipulation tactic is fake news influence. Companies or groups spread misleading news to control market sentiment. Fake positive news causes artificial buying, while fake negative news triggers panic selling. Buffett believes real value can never be built on fake information. He always waits for facts, not rumors, before evaluating a company. The third type is whale manipulation. Whales are investors who hold huge amounts of a stock. When whales buy suddenly, the price shoots up temporarily. When they sell in bulk, the price crashes instantly. These artificial movements have nothing to do with a company's real performance. Buffett avoids markets where a few players can control the entire price direction. He prefers stable, fair, transparent environments where value is real. This is why he stays away from manipulated stocks. They look exciting but are extremely dangerous. Warren Buffett strongly prefers companies that have a durable competitive advantage, also known as an economic moat. 2. A moat means something that protects the company from competitors. 3. It could be brand power, patents, cost advantage, network effects, or customer loyalty. 4. Companies without a moat are vulnerable and can lose their market position quickly. 5. Buffett avoids such companies because their profits are not stable. 6. When a business has no unique strength, competitors can easily copy it. 7. This leads to price wars, shrinking margins, and weak long-term returns. 8. For example, generic product companies often struggle because customers can switch. 9. Buffett says that a business that anyone can enter easily is not worth owning. Yes, he wants companies that are protected by something only they can offer. 11. Without a moat, a company must constantly spend more money to survive. 12. High marketing costs and low pricing power slowly destroy profitability. 13. Such companies often face unstable earnings and uncertain growth. 14. Investors may get attracted by temporary growth, but it does not last. 15. Buffett evaluates whether a company can defend its position for the next 10 to 20 years. 16. If the answer is no, he immediately rejects the investment. 17. A business without a moat is like a castle without walls. Easy to attack. 80. Competitive pressure eventually pushes these companies into decline. 19. Buffett only invests where long-term advantage is clear and strong. This strict filter helps him avoid unstable, risky, and easily replaceable businesses. Warren Buffett always avoids companies that have extremely complicated business models. He believes that if you cannot understand a company within minutes, you should not invest in it. Complexity creates confusion, and confusion creates risk. Some companies operate in too many industries at once. When a business has no clear focus, its performance becomes unpredictable. Buffett says a business should have simple, understandable sources of revenue. If the income streams are confusing, the future cash flow becomes harder to predict. Complicated companies often hide weaknesses behind fancy terminology. Investors may feel impressed, but they don't actually know what they're buying. Buffett avoids situations where transparency is missing. Many complex businesses use aggressive accounting to make numbers look better. This makes it difficult to judge the real health of the company. Complicated financial statements increase the chance of misinterpretation. When you can't understand the numbers, you cannot estimate the real value. Buffett focuses only on companies with predictable, easy-to-follow operations. He wants to know exactly how and why the company makes money. If it's unclear, he walks away, no matter how attractive the price looks. Simple companies also tend to handle downturns better. Their business models are easier to adjust during difficult times. By avoiding overly complicated companies, Buffett reduces unnecessary risk and improves long-term investment success. After understanding all the types of companies Warren Buffett avoids, one thing becomes clear. 2. Successful investing is not only about choosing the right stocks, it is also about avoiding the wrong ones. 3. Buffett's entire strategy is built on patience, discipline, and long-term thinking. 4. He never rushes, even when the market is full of hype. 5. He avoids fear-driven decisions and never follows trends blindly. 6. He focuses only on businesses he understands deeply. 7. If a company lacks transparency, he walks away immediately. 8. If the management is unreliable, he avoids it without hesitation. 9. If the balance sheet is weak, he rejects the investment instantly. Buffett knows that protecting money is more important than chasing fast returns. 11. His philosophy emphasizes safety, stability, and compounding over many years. 12. He chooses companies with strong moats, strong cash flow, and long-term potential. 13. By avoiding risky, unstable, and overvalued companies, he reduces mistakes. 14. Fewer mistakes mean better long-term results. This is his secret. 15. Buffett's rule is simple. If you can't explain the business, don't buy the stock. 16. This rule protects investors from emotional decisions and dangerous companies. 17. The companies he avoids teach us what we should avoid too. 18. His filters act like a shield against unnecessary losses. 19. And over time, this strategy has created one of the biggest investment success stories in history. 20. By learning what Buffett avoids, you start investing smarter, safer, and more confidently. 21. And that mindset is exactly what builds real long-term wealth. 22. This brings us to the end of our series on the stocks Warren Buffett avoids, and why. 23. Use these lessons to strengthen your judgment and protect your investments. 24. Always research, think long-term, and stay disciplined. 25. Because in the end, avoiding the wrong stocks is just as powerful as choosing the right ones.